All right, welcome out. Trading Justice, episode number 275. Coach T, Coach Matt here, and the market is in sell-off mode today. Matt, Monday morning, June 25th here, over the weekend, President Trump came out and talked a little bit more about tariffs on Twitter, and the market did not like it. They came in and sold early and often here today. You've got a chart on the S&P up. First on, give us some context of how you handle the first day of the week when it's like this, and then read the chart for me.
It's over the weekend. You certainly have more time for more data, more things to happen that might impact the markets. I'm looking at Twitter today, and I'm checking the news, and all I can hear out there is and read out there is bloodbath, bloodbath, bloodbath. We've talked about it, but the simple reality, guys. Yeah, it's a big candle. It's a sell-off, but the S&P 500 is only down 1.3% so far. Yeah, 35 points is a big number, but it's a big market. 20 years ago, 35-point sell-off represented, 5% sell-off. Now it represents 1.3% sell-off. And it's quickly being evaporated coming into the close of today. I mean, if you look at kind of the full day here, Tim, looking at when the market actually opened up right here. Yeah, the market opened up, sold off really heavy coming in at the very first few hours of the day. But after that, it's kind of settled down, and coming into the close right here, you see a lot of buying coming into the close. And, we call it a ramp, but a lot of times that's what we see. We see a sell-off initially coming back. So what happens over the weekend is you have a little bit more news, you have a little bit more time. You have the markets opening up on Sunday night internationally. We live in a global market. So when the Sunday night opens, it's pricing in Friday afternoon, Friday night, Saturday day, Sunday day. And so you have all this more time coming over the weekend than you do between a typical Tuesday to Wednesday type of situation where, you really only have, about 17 and a half hours that news can come out to impact the market versus the weekend where you're dealing with, 2 days. Basically from Friday at 5 p.m. Eastern Standard Time when the banks close till Sunday 5 p.m. Eastern Standard Time when the Sydney banks open. So you have 48 hours that could really kind of impact it. And especially when we're dealing in 2018, when we're dealing with all these different geopolitical situations where, these trade wars and tariffs and whatnot, currency wars still going on. This amount of time can bring up a lot more data, especially when you're dealing with the president who is very, very open on Twitter.
Well, I'll read you the tweet. I mean, this was the tweet he put out on June 24th, just yesterday, Sunday afternoon. People are relaxing, President Trump. They don't want to have to worry about the market crashing, but you did it. The United States is insisting that all countries have placed artificial trade barriers and tariffs on goods into their country. Remove those barriers and tariffs, or be met with more reciprocity. He capitalized
so somebody needs to sit down and talk economics with President Trump, how it really works. But the simple reality is those types of information will have an impact on the market. And we know our listeners want us to just talk about economics and, trading and whatnot, but politics plays a role in economics.
Sure does.
Politics plays a role in price. You can't just say, well, don't talk about this, but talk about that. If you want to be an investor and a trader, you got to be open-minded to everything. It's about numbers. It's not about what you believe. It's about what you see. And when you have an impact like that, it's going to impact people. And you're right, Tim. Sunday afternoon, nobody wants that. Nobody wants to discuss trade wars and economic wars and trade tariffs on a Sunday afternoon. But it's going to have an impact on the marketplace, and that's obviously what spooked the market coming into today. But what our job is to understand why the market. It's not necessary to understand why the market's doing what it's doing, but to project where we think that is going to be impacted in the future. And you know what? The market ended up down about 39 points today, 1.42%. But I'm not surprised by that in the S&P 500. It's still in between two rising moving averages. That's a buy zone. Last week when we were looking at this, basically we said stay away. I'm not a buyer or a seller coming into this. We were in the middle of support resistance between 2,800 and 2740. I mean, it blew past 2740 today. I mean, didn't even bat an eye. Just boom, drove all the way back down to 2,700, kissed off at 2,700, starts moving back up. But the index I'm looking at as a
Well, just real quick on that, because it's interesting how, and I'm with you on the YM as well as the NQ. Those are probably more important today, but the ES hitting 2,700 even. Guys, a lot of these technical analysis components, you learn that round numbers matter. They do. I mean,
they do.
the psychology of mass psychology, it plays itself out a lot over time.
Well, look at it today, Tim. Just look at it on this 15-minute chart. It is screaming down today. And where does it find support? 6,995 at the very bottom, but really kind of on a $7,000 index, that's 7,000. Just look at that, just getting absolutely butchered. It's a free fall. You jumped off a cliff and then you found 7,000. Looking at the YM contract here, just getting absolutely butchered, find support right at 24,100, right? But what I'm looking at on the YM contract, which is the Dow Jones, is look at this, and we've talked about this in the past. Kiss, 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 kiss. Tim, we're sitting right at that 200-day moving average. Now, technically, you are slightly under that 200-day moving average. That has not happened in a very, 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 very long time. I mean, if I go back on a daily chart here for the last 10 years, okay, for the last 10 years, and we're just looking at kind of that from that time frame perspective. The last time you closed underneath,
and just stay right there for a second, because that picture tells a lot about the volatility. We haven't tested the 200 this many times in a short duration for a long time, Matt.
Not since 15. It hasn't been since 15. And in 15, you were talking slowing growth in China is basically what was happening in the summer and early fall of 2015. But I want to look at just kind of the last time it did this. You see right here, it's getting just beat up, closes underneath the 200-day moving average. This is in June of 2016. Snapback rally comes right back up, right? Snapback rally comes right back up. I don't necessarily consider what's happening today as a close underneath the 200-day moving average. Yes, technically it's slightly under by a few points, but it is in that zone of support. It's in that same zone of support as here and here. The only question I have is this a buying opportunity coming off the 200-day moving average? Now, obviously, I don't think it's wise to just jump into, a swimming pool full of sharks and just say, hey, listen, let's go buy. Right.
Well, there's that saying, we had a podcast on it, don't try to catch a falling knife, right?
Yeah. Let it fade out. Let it fade out. Let it slow down. And if it slows down and starts that U shape going up, at that point, I think you might have a good buying opportunity. But Tim, I do kind of feel, and this is not a technical thing. This isn't an economic thing. I just feel like there's some difference today versus when it was touching back here, right? It just feels like the economics and the political discourse is even nastier today than it was even a couple months ago. I mean, if you think back a couple months ago, Tim, even though we were kind of talking tough with China, I mean, Trump was tweeting to President Z, you're my best friend. We're buddies, right? We're buddies. We get each other. I want to be him type thing. There does seem to be a little bit of a more negative vibe coming out of the White House right now regarding these trade tariffs, regarding these economic battles that they're having from an international perspective. And I don't like that. So again, this is not a technical thing. This is not a fundamental thing. This is not an economic thing. This is more of a behavioral thing. It does feel like there's a little bit more tension, a little bit more negativity, and a little bit more fear, even though it's only 1.5 points down, than it was coming into this. I mean, for the most part, we had 8 straight days down coming into it. Even in the bloodbath that we saw in February, you didn't have 8 straight days down. You had 2-3 days down, whipsaw back up. I don't know if the buyer's going to come back in to the same degree that they did back here in April, what they did back here in May, and obviously what they did in February. It just seems like every 2 months we go through this cycle again. But I'm looking to buy off that 200-day moving average. I'm looking to buy coming off the NASDAQ which is still in a rising uptrend, still above support. And I want you to look at the NASDAQ. If the Dow's showing some weakness here, Tim, look at the NASDAQ here, okay? Old support right here, real strong breakout candidate off that high base situation, big candle on the breakout, set a higher high at 73.58, getting beat back down, coming right back down into that old support level now, old resistance level, now new support, smack dab at that 7,000 level. If I get a doji candle here, followed by an upward moving price on Wednesday, that is a good trading signal on the NASDAQ.
Stay there for a second, because what you just said is in line with the podcast overall message here today, and that's system design and development.
Yeah.
So you know that this pullback is bringing us into a buy zone, moving average, old resistance, everything you just mentioned. And now what you're doing is you're planning an entry based on what could happen over the next couple of days to get what's called confirmation, Matt. And having those kind of, metrics is invaluable for trading,
Well, I want you to look at something real quick right here. Okay. There's a lot of different ways to trade.
Are you trying to upset me right now?
I am not. I am trying to prove a point.
All right.
But I do know Fibonacci gets your blood boiling a little bit. There's a lot of ways to trade. There's a lot of ways to make money, and there's a lot of ways to identify a buying zone, and that is support, right? Where we are looking to buy a support. One of those is a significant whole number, which we're hitting at 7,000 on the NASDAQ. The other one is a previous level of resistance, which is, again, right here, now, right here. So that's it. So we're hitting a whole number. We're hitting a previous level of resistance. Another one is rising moving averages. As you can see, we're in between the rising 20-day moving average here and the rising blue line, which is your 50-day moving average here. That is called a bull area. That's number 3. Number 4 is what we call Fibonacci retracement level. And so if you look at me draw this entire wave right here, so from the previous support level to the current resistance level, where I'm drawing that entire wave. And as you can see, if I just kind of highlight this right here, that is coming down right smack dab into a 38.2% retracement. Now, for those of you who don't understand what Fibonacci is, that is between a 38 and a 50% retracement. I would say is the number 1 retracement zone according to Fibonacci. So we're also at a Fibonacci zone, Tim. The only thing we're really kind of not at right now when it comes to this is we're not at any dedicated trend line. So, I mean, if you're looking to draw your trend lines, connecting the dots here, 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 and here. So if I'm looking to try to find an argument here just in terms of connecting the dots, if I connect all those dots right there, and I connect all of those, that's your best case scenario on that trend line. And then this is your best case scenario on this trend line. So if I'm drawing those trend lines, Tim, the first red line I drew, that is your primary trend line. That is your long-term trend line of support. The second line I drew is your short-term trend line connecting the support here to support here. And that's kind of in that ballpark too, but it's not necessarily there. So you're sitting at a significant whole number. You're sitting at a Fibonacci retracement zone. You're sitting at a previous level of resistance. You're in between 2 rising moving averages. That there's a strong case for the bulls coming into the rest of the week, specifically on the NASDAQ and maybe on the S&P 500 as well.
Well, so and think about this, Matt. Think about this. Bullish traders and investors who run capital, they're not going to change their fundamental outlook because of a reaction to news. So, I mean, I'm not saying they're going to be right, but they're probably willing to bring the money back into the market if they believe in forward earnings and the uptrend. And
I also don't believe, Tim, that they're going to run away from the market simply because Trump is tweeting again.
That's right.
We're used to that. Right? We're used to that. It just took a little bit more time. And again, the one thing I want to make sure I'm abundantly clear on, this is not a bloodbath. We are only down 1.5%. A bloodbath, this is a bloodbath. Okay, down 5%, down 5%. Whipsaw impact. 2011 was a bloodbath, right? August 2015, bloodbath. June 2016, bloodbath. September 2008, bloodbath. March 2000, bloodbath. That's a bloodbath. Down 1.58%. That's not necessarily a bloodbath, especially given the fact that most of the market did go down, but not to the degree where nothing went up. I mean, when I'm looking at the heat map here, Tim, I still see green. A bloodbath is full red. But look at your consumer goods, okay? Kimberly-Clark up 3% today. Your consumer good processed and packaged goods, General Mills, Kellogg, a lot of these food-based companies doing fairly good today. Look at Walmart up close to 2% today, right? Look at your utility stocks here. Across the board, except the one that is on the tackle 25. That's funny right there. Across the board, they're up 1%, 2%, 3%, 4% across the board. There's always opportunity out there. Even when the markets get really, really nasty, you're seeing a little bit of flight to safety. Walmart is safety. Utilities are safety. Kimberly-Clark is safety. Procter & Gamble can be safety. Food-based companies, utility-based companies, they can be safety. Where we're seeing the bloodbath, basic materials. We're seeing a little bit of bloodbath in technology, credit-based services, finance. Those where we're seeing kind of a bloodbath, but overall not horrific out there. Especially people are still drinking Pepsi. It's up 0.65% today, and Coca-Cola 0.89% today. So when we're looking at these types of situations, the one thing that I would recommend for everybody, don't get caught up in the headline. Don't get caught up in the headline, because a lot of those headlines are driven through economics, clickbait, yellow journalists, sensationalism, all of that jazz. And I don't get into the fake news type nonsense, because I do believe it's nonsense. But most news in 2018 is driven through sensationalism, is what it's driven through. What is not sensationalist is based on price. That's what you have to focus on. If you're a bear, make the bearish case based on price. If you're a bull, make the bullish case based on price. And coming into this week, I was a little, obviously we knew what was going to happen today, Tim. We kind of were ready for that coming into the market day. I do believe it's a slight overreaction to the news, because we've heard this before, right? Sure. So I do believe it's a slight overreaction. I think the bullish case above 7,000 is very strong on the NASDAQ. Underneath 7,000, my analysis would change. But above 7,000, I'm still a buyer on the NASDAQ tech stocks. FANG is still alive. On the S&P 500, on the Dow, it's fight or not. It's fight or flight right now on the Dow. You're sitting at the 200-day moving average. That is a fight or flight type situation on the Dow 30 stocks. It's in a very precarious situation. And when you're looking at the S&P 500 here, I'm looking at a potential support zone right now at 2,700. If it breaks 27, your next support level is right where the Dow is at its 200-day moving average. Out of all of the indexes right now, I'm kind of taking a look at the Russell 2000 here, Tim. Out of all of the indexes right now, I like the NASDAQ and I like the Russell 2000. Those are your strongest cases for a buying opportunity. And when you're talking to me about the strongest cases for a buying opportunity being small and mid-cap stocks followed by aggressive tech stocks, we're still in a bullish mentality.
Yep. Confirmation, guys. Tomorrow is not a day you take off in the markets if you are a trader. There's no doubt about it. High volatility day, maybe not a bloodbath, but definitely above range. One thing that's really interesting, that old phrase, the bulls take the stairs, bears take the elevator, today kind of reiterates that point, Matt. 2 or 3 weeks of gains, and then, boom. And
nobody jumped out the window, though. I want to make sure that's clear.
They did take the elevator. They did take the elevator. That's right. All right, let's move on to crude oil, because there has been a lot of volatility in that one as well. Crude has started to go back up. In fact, it had a really, really strong bullish pivot candlestick last week as it was putting in a new high. From a pivot perspective, and then Doji today. Give me a read on this one.
I still think it's in a very volatile and precarious situation from a daily chart perspective. I expect volatility to transpire in the short term, especially given where the fear is in the market right now. Obviously crude had a very, very good last week where it drove back up in price, got above its moving averages. That's a bullish signal. Got above this very important trend line. If you look at kind of this trend line here, this trend line dates back to when this bull market kind of started last year. It's been very consistent on that trend line. It got back up above that trend line this past weekend as well. That is a bullish case for it. But I think the biggest bullish case for crude comes off the 200-day moving average, comes off the weekly chart, where you still have higher highs, higher lows, higher highs, higher lows. Look at that U-shaped right there, big upward movement in price. That is the strongest pivot candle in the weekly chart that crude has had in this run. I think that's a bullish case coming into crude. If you're looking at potentially trading crude, I think your target is the highs, is 72.9. I think is the most you can target right here. For me, I think the best way to play crude right now is through credit spreads and naked puts in the oil market, doing something theta positive where you have some range, take the volatility out of the equation.
Gotta love big green candles if you're bull, and it did break that little mini resistance, Matt. After about a month of volatility, started to go back up. The fact that the market had so much selling today, crude only down 0.79%. A little relative strength in the commodity there. There's no doubt about it. Let's move on to gold. And there's gold.
Gold slash GC. Let me pull it up. So we got slash GC. Gold, weak. Said it was weak last week. It's weak today. But here's the kicker, Tim. My price target ever since it kind of broke underneath 1,300 was 1,260. And you can kind of see the box I've driven here. It's between 1,240 and 1,260 based on historical support resistance zones. So you see this little gray box. That's your zone of support or resistance. It is currently hitting that zone, is showing a little bit of slowing momentum. You might expect a little bit of a rally coming back up into resistance, but we're still bearish here. Don't pick the bottoms, guys. That's not what traders do. That's not what savvy investors and traders do, is try to cherry pick the bottoms. That's not who we are. Wait for confirmation, and confirmation is when we get a double bottom, breaking out of resistance, and we're certainly not there yet. However, I do believe the selling might subside a little bit coming into this week. There's still a little bit of fear out there. Maybe you see a little bit of that fear drive up into commodities, driving it back up into resistance. But as for the bull case, it's not there. The bear case, if you're looking to short gold, protect gold, I'd wait for a rally back into resistance and then, basically reset short on the way down.
So much of gold weakness is because of dollar strength overall. Now, the dollar was down a little bit today, but really, in general, it's been very, very, very strong. 3 red candles in a row, pulling back into a moving average. But you have some slowing momentum here, Matt. The big pop-off rally in April and May hit a new high at 95, pull back to 93. Now we've tried to break out of 95 and failed. Are you still bullish on the dollar?
Well, I think you have to be. But I'm certainly not as bullish as coming into, say, last week or a month ago. You said something very, very interesting when you first started looking at the dollar here, Tim. When you were looking at the slowing momentum impact, and if you look at kind of momentum from a standpoint, momentum has a tendency to continue in the future, according to Sir Isaac Newton. And so here you got from 89 all the way up to about 93. So you got a 4-point movement followed by a 92.5 to 95 2.5 point movement, followed by a 93.5 to 95.5 a 2-point movement. So basically the higher highs, higher lows are still higher high, higher low, but they're not showing this strength that it once did. That is called slowing momentum. Many times slowing momentum leads to a neutral trend. And so even though you have slowing momentum, I'm not ready to call this the dollar pain train it's been putting onto the rest of the world currencies. I certainly don't think that's over. Last week, Tim, I had a call that the dollar was going to come back down in price. This week, I feel like the most likely scenario is we pivot back up into 95 and we hold somewhere between 94 and 95 is kind of where I see it from a technical point of view. So that's kind of, I don't think anything aggressive in the currency market this week. Let's wait to see how this plays out. Currency is kind of like pick your poison, pick your spot. And this week, you're sitting at a support level, rising 20-day moving average, but you still have some downward pressure here. You're showing slowing momentum on your pivots from your higher highs to your higher lows. This is all a cautionary tell. And what I would recommend for you and for everybody that's listening is to maybe stay away this week, wait for some better price action coming in to the immediate future. I mean, when you're looking at this, we're always going to have opportunity. Slowing momentum, in between support and resistance, I think that's a stay away.
Bitcoin, last one. The cryptocurrency markets have been in a bearish trend now for most of 2018. There's no question about it. A couple of
What,
relief
Bitcoin down
rallies.
72%? Do we call
Yeah,
that bearish?
it's been ugly. And even in the last 2 months, it's been ugly. It's gone from
Yeah.
10K all the way back down to 62. That's another 38% drop in this sell-off. Below all the moving averages, sitting on support. Man, I got to tell you, this would be about as much of a gamble as you can imagine in the markets right now, Matt, with Bitcoin. There's not much here from a technical perspective, fundamental perspective to get excited about, is there?
I said last week I want to buy Bitcoin with your money, and I'm still there.
Yeah.
I mean, it's a stay away from me in every single capacity. You know, I mean, the crypto phase is obviously gone. It doesn't mean it's over. It's just gone right now. People who got in late 17 got their ass handed to them in the first half of 2016. They don't have the thirst for the risk like they thought they did. It's easy when you're making money. It's not as easy when you're losing money. You just give up, and we've seen that go away. A lot of the pros got out. A lot of the pros didn't hold. The pros got in, got out, took the money and ran. The only question is there going to be another opportunity in the future? And right now, I don't think that's the case. I still think this is a kind of a stay away from me. It's been a stay away from me for the past year. It's going to continue to be a stay away from me until I see it drive down in price to such a level that it's like, let's shot in the dark type this stuff. The key level of support is 6,000. It's currently kissed off that the last couple of days, 62.55, just down about 5 points on the day so far. But if you look at that 6,000 level, that is such an important level, that 6,000 to 6,500. You're right there into the support level. If I'm a holder, I would be very worried of a close under 6,000. 6,000 holds, you might get a bump back up, no doubt about that. But if you're a holder and that closes under 6,000, watch out below.
I think in the Bitcoin market, they call them hodlers. You
Holders?
have to hodl or die or something like that. It's a funny thing.
They might die.
Yeah, they absolutely might. It's going to test the emotions of all those Bitcoin believers. There's no doubt about it. Guys, that has been our market skyline, and here's the thing to do. Tomorrow, Matt and I, the coaches, we're going to be watching the markets, and then there's a coaches show at Tackle Trading each and every week. I would watch that, make sure that you see what goes on Tuesday, the day after today's volatility, because these key levels are going to be in play. And one way or the other, Matt, we've got a 24-hour a day market. By the open tomorrow, we will know a lot about how the market reacted to this sell-off.
Absolutely.
And see how it plays out. More on the coaches show throughout Tackle Trading and through the week. That's what we do over there. Guys, we're going to take a short break. Be back after these words.
All right, Tim.